Now we'll switch tack and we'll talk about our industry, the venture industry, and we thought it would be a good opportunity today to have a dialogue between us investors, VCs, and our investors, so an LP-GP discussion. So I'm very happy to introduce, I don't know if everybody's ready, Margot Doyle from S Cubed, who is running the family office of one of the early investors in NVIDIA and former Sequoia partner, Mark Stevens. Gregory Schmidt from MEAG runs the investment arm on the private equity side of Munich Re, and a new addition to the Felix LP family. Thomas Stafford, sorry Tom, with whom I've had the pleasure to sit on boards, a great investor from DST, and there was many successes behind him, including a more recent IPO of Nubank, very large outcome, and Antoine Nussenbaum from Felix Capital, and Ivan from DFT, deal reporter at DFT, will come to moderate the panel. So please welcome them on stage.
As you like.
All right. Good afternoon, everyone. Thanks so much to Felix for hosting us, and thanks to our panel today of GPs and LPs. I think it's quite unique to have this kind of dialogue crossing the Great Divide. Some incredible institutional investors, family offices, some very humble venture capitalists. So hopefully we can cover a broad range of topics. And if it turns into a mini therapy session about the LP-GP relationship, that would be okay as well. So Antoine, I want to start with you. If you can just set the scene a little bit for us, how Felix is viewing the European AI investment landscape and where the opportunities are today.
Thanks, Ivan, and thanks for moderating this panel. So we are very, very excited. We truly believe that our positioning we came with 10 years ago, a decade ago, around the power of brand, the power of design, is shaping in this new era. I was actually listening over the weekend a podcast with Dylan from Figma, who was saying exactly the same. This is the era of design, and design will incorporate branding. When 2 years ago the wave of AI started, we felt that us, with our font size and our focus, where we often say intuition backed by data, it felt for us too early to invest in AI very quickly, and we wanted to see, learn for our portfolio companies, while actually on the consumer side, the entry point on the valuation side were very low. 2 years in, we have clarity. Actually, Angela and our team published with Maya Raga recently, analysis of behaviors on ChatGPT, which specific industry and verticals is specifically impacted. And so now we know where we want to play on the application layer of AI, being around education, healthcare, loneliness, and so on. When it comes to B2B, and we had a great example with Chris and Andreas earlier on, we love B2B, sorry for the word, but dusty, big vertical into a B2B, where AI is not just adding something, it's being completely transformative. And it's not random if you see a Chris that has been a founder and a very successful founder for over 16 years going back at it, because he knows his sector inside out, he knows the buyers inside out, and that's the type of thing we love to do at Felix.
Thank you. And Tom, I want to turn to you. DST has always had a very global view, across Asia, Europe, US. How does Europe kind of fit into your portfolio, and even kind of speaking to what Antoine's mentioning, the application layer, the larger models? How are you thinking about those different themes?
I mean, Europe for us, if you look at the kind of 16 years since we've been around, Europe has averaged about 15% of capital deployed. And it hasn't changed materially. If you take a rolling 3 years, obviously year to year it changes, but the 15% has been pretty constant. I think as a European, that's a little disappointing, but won't change anytime soon given the amount of leakage we have of founders to the US. So if you adjust for European founders, not for European located companies, the 15% increases materially. But just based on where, actually being based in Europe, it's 15%. In terms of AI, I think we're probably representative of that as well in Europe, in the sense that if you look at sort of the two main foundational model companies coming out of Europe, which is Mistral and Poolside. Poolside's a little bit straddling the pond, but let's say it's at least partly Europe. If you take those two, I would put them in a sort of the 10 to 15% scale compared to the US peers. And if you look at the application side, we're probably a little bit underweight compared to that. But if you look at the likes of Lovable, Parloa, Synthesia, and a few 11 Labs and a few others, it wouldn't be 15%, but it's a material single-digit percentage point. I think the biggest risk is the pace of adoption of enterprise actually in Europe is much lower than in the US. And what I mean by that is right now there's a lot of money to be made in consumer AI, but that's really being driven by US companies. And most of the money outside of ChatGPT will be made in enterprise and developers. And unfortunately, European enterprises are extremely slow to adopt AI, which is favoring the US AI companies because they are seeing much more adoption in the US. So for example, there are probably 200 to 300 companies in the US with more than 5 POCs or quasi-POCs of $1 million or more. I think we've struggled to get past 5 or 6 in Europe, AI POCs. And that's just indicative of this kind of slow moving of European enterprise. And that's what's going to harm European tech more than anything.
Thank you very much. And Margo, I want to bring you in from the LP side. You know, when you're thinking about your allocations in venture, how do you think about geographic distributions? You know, is that relevant? And then how do you think about AI exposure? You know, is there a risk of having too much? Maybe can't get enough in this market?
Thank you, and happy to be here with you all. So in building our portfolio, I think portfolio construction is actually the hardest part of having a portfolio as an LP. We talk about trying to concentrate into just the winners, but it's really difficult to know that in advance. And so the pattern recognition and building of the portfolio, we do think that if you look at history and try to build the pieces, the US has dominated a lot of the innovation, but you can't forget some of the nuggets that were created in other markets. And so it's about balancing how much you're going to have in the diversification, but I think it's difficult to avoid markets altogether. So we've consciously tried to have a geographically expanded portfolio, but then that doesn't only have to come from your venture exposure. So in our case, we have some large single public stock exposure that is a global company. And as that company kept increasing its dominance globally, that alleviates a little of the pressure to be chasing to find some of the geographic exposure. And we can look through to see where the customer and the revenues are coming from to deepen our comfort that we were getting that exposure. Venture in itself, we're a family office, and so we have a unique duration that we're investing behind. And we also, the genesis of the wealth for us was out of investing in innovation and venture. So it's an area we're comfortable with. And I think in my 25 plus year investment career, ventures had to fight for its reason in the portfolios. People have been afraid of the returns of it, afraid of the risk of it. We've been able to come to the table comfortable putting venture into our portfolio, looking to have those opportunities for the inflection points of innovation. The last piece, and then of course we have to get you into this perspective too. In moments like this though, where you've only seen the bubble expanding, the balloon, filling with air, you have to ask yourself at what point do you need to put some caution in there? And again, I try to not predict, I can't predict, but put in some risk parameters, take a little bit off. Maybe you take a little bit of exposure off. Maybe you take some early returns and just say, I'm not trying to maximize for the ultimate out point, and be okay with some of the interim pieces. But.
Yeah, Greg, I don't know if you want to jump in. I think historically there's a feeling that there's a gap between European LPs when it comes to venture versus the US. Are you seeing a shift among European institutions towards investing in venture?
Yeah, so I would say I could give you a comment more generally on the market and what we've done on that basis. I think as you could hear, I'm French, so I started my career in France. And when you looked into what French investors were doing, they usually were backing smaller VC funds based in France. German investors would do very much the same, backing smaller funds based in Germany. And based on doing so, these funds were, in average, maybe less successful by returns than their peers in the US. So some of the investors either stopped, and a bit of, as you described, Margot, actually, most of the LPs are not, were not created by innovation, in a sense. So doing venture is like the funkiest thing you would do in your portfolio on the day-to-day. So when things go sour, in a sense, people will tend to take hands off and say, why on earth did we ever do that? And I think that moment happened for many investors, at least during the GFC on that perspective. For us, we've been lucky to be around as a firm since a long time. And initially, we focused our investments mostly on the US side of things. And the approach, and a bit to what you said earlier, we don't have, I don't have a bucket where I'm going to say I'm going to do 5% in Germany, 10% in France, and the rest wherever. We'll have a pure financially driven program. So if I find the very best opportunities to be in the US, I would do all year long US. If I found the very best opportunities to be found in Europe, I would do Europe all day long. And I think this approach of being very focused on conviction, you don't know, as you said, at the moment where we do, we just invested here with our friends of Felix. We have high conviction that this is going to be a great investment in the universe we can invest in, but we don't know yet. There are bases that show, there are assumptions we've made based on facts, but future will say if we were right doing that decision in 10 years' time.
For sure.
Maybe to turn to Antoine. It's definitely a different market when it comes to investing. Is it a different market for VC firms? Do VC firms need to evolve in terms of thinking more flexibly about how they invest, the kinds of people they hire? Do they need different kinds of expertises?
I mean, there's something we were chatting about with Tom just before at the macro level. There's still, despite the 2022 hype, there's still a lot of money out there, and far, far more money than when we started a decade ago, or when Frederick started in 2001. So the market is more competitive, which is great for founders. They have many, many options. And I think on our side, what we're always trying to be is consistent with the brand we're shaping. And we want to be known for what we're good, from what we can partner well with our founders. We spoke earlier today about two companies on the B2B side. I mean, one on the B2B with Travel Perk and one on the B2C with Voy. They have both rebranded. So Voy used to be Manual, Travel Perk is now Perk. And they took us originally to be part of this journey and to help them be sounding board, to help them define who they are. And that's also the way we execute and operate. We like to have a lot of clarity. So that's why in the current market, we saw, to our taste, with our fund side, a bit of exuberance in the beginning in the last couple of years on the AI side. Now it's been digested, it's been very clear, and it's going back to sticking to our playbook, which is the thematic piece at the center of what we do. And then we couple this with data and AI, which is amazing these days, but everyone has access to this, and with strong coverage. But what is the glue around this is our thematic lens, and with the power of brand, the power of design, and the power of data, which has been exactly the same themes since we launched 10 years ago.
By the way, I would also say, I think everybody likes to think things change a lot. I don't think things have changed all that much at all. Ultimately, there's a few companies in every year that will drive the returns. There are another handful or two that will do okay. And unfortunately, the vast majority won't make any money for you. And that's true for this year, it was true last year, it'll be true 10 years ago, it'll be true in 10 years as well. And so the job has always been and will remain finding the unique founders building something sustainably unique in a very large market. And that's the same thing 16 years ago when we started, when you guys started. I think it's exactly the same today. Deal speed is maybe a little faster, check size is maybe a little larger, but ultimately it's exactly the same story as it was 15, 16 years ago.
I think one of the questions then, which I agree, is what are the things we can see that's changed? So check sizes have increased, but the amount of capital chasing those check sizes. So which is the chicken, which is the egg? And I think we have to then look and see, are we being reactive or are we staying true and consistent to our strategy? And I think those are some of the elements that we're trying to assess as we meet with GPs to figure out how do we think they're going to be positioned going forward. And I do think sometimes we see people trying to chase or to play momentum, and those are usually easier reasons for us to say, interesting, you very well might catch it at the right time, but that's not something where we want to be invested with somebody in continuity with them.
And I think just to follow up on that, I mean, what are you kind of looking for in people who are fundraising and the managers that approach you when it comes to the GPs, and maybe even if you could speak specifically to how they're thinking about exits?
The things I look for, perhaps most of at the top, the capital that the GP, the perspective of the GP has to have a purpose and a meaning to the founders. So we like it when we see GPs who have some domain expertise, some operational background, some execution consistency, where they've really carved something out. People are assigning brand to that these days, but the brand to me is more ethereal and it could change. The core work that's being done, can you see the consistency of it, the repetitiveness? Are they building a team to come in? Succession is a really important thing at these firms that's happening right now. And so that probably is one of the most important to me, that when a founder looks at that GP, are they going to say, I want to sign up with them, not because they're going to give me the highest price check, but because they're going to actually help me grow my company right now. And to your question of exits, that's another one of my concerns right now is companies, we talk about, several people up here talked about sort of the iterative nature of building these venture companies. And companies at the valuations they're given right now and with the amount of capital, they're not necessarily being allowed to make the mistakes and to make the pivots that need to occur naturally in growing companies. And whether that's pricing for perfection or what have you, you're forcing exits that are going to have to be very difficult to conceive in an environment where the iterative process has been what I think delivered really strong returns historically. So we find these are the really challenging.
I'm not sure I agree with that, by the way. I think if you look at most of the companies, they iterate whilst growing. Most of the great companies iterate whilst growing. There are a few, like a Slack, that iterated before growing. But if you think about a Meta, a Google, an Alibaba, a JD, a Nubank, a DoorDash, these all grew from very early on, and of course iterated hugely and added product as they went, but they didn't iterate sort of from day one on the core business model. And I think...
But all of those companies, the initial valuations at which the investor capital was put at risk was much more reasonable. It was given opportunities to multiply and be rewarded for taking those iterating risks along the way.
That's partly true. I'm not sure, like if you actually do the math, it's completely true, because the opportunity set and the market caps that are being driven today are actually larger on the outside as well, like on the outcome.
True.
So when we would have been investing in Meta or Baba or Airbnb 15, 16 years ago, the idea that there'd be $1 trillion tech company, I mean, that was kind of nonsensical. We actually had it in one of our decks, but it was a nonsensical idea. Today, we have a $5 trillion tech company, right? And so I don't think we can always hold the math constant over a 15, 16-year time frame. And then secondly, the most important part of all of this is, again, you've got to be in the winners. It, of course, matters in your entry price. But what drives all returns is, were you in the winner? If you are not in the winner, you cannot drive returns. And when I say returns, I mean DPI. I don't mean like some nice piece of paper. But the only way to return money is with winners, because M&A will not bail you out. IPOs are the way in which you deliver real dollar returns to your LPs, at least in my way of thinking. And it's only great companies that get to go public in a sustainable way and a way in which you return dollars. Therefore, yes, you don't want to overpay, but you don't want to underpay and be in the loser.
Correct.
So either you stay out of the market or you get the winner. There is no other way of going.
Well, I think if you look back, and I've been out of Cambridge Associates for a long time now, but if you look back historically, the net top quartile returns for venture was around a 2.5 to 3x net venture fund return. There's so much noise in the current TVPIs that it's difficult to know where we are, but I'm not sure that that top quartile is going to suddenly have a 6x or a 7x be the bogey. And so I think you can create very compelling portfolios that return in that 3x without needing to only select the highest price. And it comes from fund discipline and getting into companies that have real market purpose that could be attractive along the way to one of those global companies, but gets acquired at a wonderful multiple, delivers you, the investor, a steady 3x, 4x multiple. That works in my portfolio all day long.
I think that's really hard to envisage today. And I think it was really hard to envisage 12 years ago, and I still think it's very hard to see today.
I just want to let Greg jump in here, because this is basically dancing around this big kind of bubble topic of what happens, when valuations are inflating, and basically kind of everything becomes higher stakes in these decisions. So Greg, how are you kind of navigating that question of, are valuations just unrealistic, or, as we're kind of saying, there are still going to be, like in every vintage, some massive winners, and you just need to make sure you're in them?
So when I heard the two of you, I thought the answer is very easy at the end. Just pick managers that pick the good companies at the end, which is a bit of the summary. But
so how do you do that?
But back to this point, I think any managers that would come to our office would usually, in the last 10 years, they would tell you their first quartile. That was the first thing. The second thing they typically now tell you, and we have a bit of a game in my team, we call it the AI bingo. So every company in the last 3 years, literally, and usually it comes at 30 seconds, like once you pass the, hey, how are you, how did you arrive, did you have a good flight? Usually the thing arrives in, hey, we invest 100% in AI today. So a bit of is there hype? And I actually agree to your point. I think Europe is seems to be behind in terms of adoption. You see it when you arrive. I'm sure most of you went to the San Francisco airport not too long ago. You just feel like you're in the epicenter of AI. When I arrive in Munich, I don't see AI. I see cars and watches. This is literally what I see when I arrive at the airport. So I think it's just an example, but literally the adoption is a different one. But I think from the valuation side of things, as you were asking, at the end of the day, people investing in venture should know, that doesn't mean it's not important, but should know that it's a long-term game for both sides, for the GP and the LP. So I don't mind having years like the last 2 or 3 where I think if I had to count the distributions which were halfway meaningful on the VC side of things, I won't bore you for too long on that perspective. But we're in a business where we need to be active in a partnership model, and it's a bit of a. I don't think the partnership between GPs and LPs is broken. I think it's if you have the good set of GPs and LPs which are aligned on that perspective, and alignment comes through same set of objectives, but also GP commit and all of that. I'm more than happy to wait 1 or 2 years later in order to go for these extra round of returns. I'm very critical today of these continuation funds and all these type of engineering, which was day to day on the private equity side of things or on the PE side of our book. It's coming over now to the VC side. I think the LPs are on the worst position ever to take decision on to buy or to sell a company. I think there's a difference in information there, and we're paying our managers a decent amount of management fee and carry to to be able to take that decision on our behalf. So we're patient. We'll wait for the right moment, and we'll spend more time into picking the right managers than trying to time when it's a good time to sell that or the other company.
I fully agree, by the way, about continuation vehicles. I think it's people trying to shaft each other.
And people don't understand that there's a price to it, and I think that's a bit of the, there's a whole discussion of, because GPs will tell that the LPs are pushing for that. I'm sure there are LPs pushing for that, but I think, there's a secondary market which exists. There are players that do that. Discounts on the venture side of things are pretty huge. There's a reason for that. And usually the valuation on these continuation funds, there is a fairness opinion and all that bullshit, excuse my French. But I think the price is there and people should just realize it.
We used to only write about continuation funds for private equity, and then about 2 years ago, suddenly, all the big VC firms are setting up their own vehicles.
Not us.
Yeah. Antoine, 10 years for Felix. So far, so good. We're looking at the kind of GP-LP relationship, from your perspective. Has that kind of evolved over the years, and what have been the key ingredients?
The key ingredients is to pick
There's one key ingredient.
pick this type of LPs that are forward-looking, that not pushing you for liquidity, and so on. Because if you look at any books, the massive part of the value creation usually happen in the later years, and despite sometimes we see people forgetting about this, but that's the VC game. So we're looking for LPs that are here for the long term. We looking for LPs where we can build trusted relationship. It's a decade already, so we're 10 years in, but believe me, it feels very much like the beginning for us. And so, what's been interesting to see in the European landscape is seeing people like Greg from MEAG, but has been more focused on the US. I met him in Utah eating a raclette.
We did, yes.
6 years ago. And
so that's the secret, eat raclette with your LPs.
And at the time, I don't think you had any Europe relationship on the venture side, and that's coming. And so seeing these people coming back to Europe to diversify and seeing family offices getting more and more sophisticated, these are the type of partners where we can build a really long-term relationship. It doesn't have to be only endowments or institutions and so on.
Thanks so much, everyone. I think we're out of time, but great discussion, a true discussion. So thanks a lot.
Thank you.
Thank you.